Greetings, Dr. Jeffrey Scott here. This is my weekend market update for October 27th, 2024. Off the cruise ship, so I actually have internet that works. I tried doing this earlier and I just had challenges with connections. Again, my email address is hgsidoc@gmail.com. If any have questions, comments, remarks, feel free to email me or put them in the remarks section on YouTube. If you're new to my channel, hit the subscribe button, hit the alarm, and you'll get notified when I put these up. And if you like what I'm doing, give me a thumbs up. As always, this is for educational purposes only. Anything I talk about should be taken in the spirit of education and not considered investment advice. I'm a doctor, not a broker. I'm independent. I do have tools that are embedded inside a number of software platforms, some in the base program. Many of them are premium tools, and I have relationships with those vendors, but I don't get paid for talking about anybody's product. I don't promote any one product versus another. I show you how I use the tools, and I've paid for all the tools that I demonstrate. Trading involves risk, and you are solely responsible for any investment decisions you make. If you like these videos and you want something shorter, take a look at stocksanddocs.com. I put things up most days during the week right before the market opens, and they're closer to 6 to 10 minutes. I always like to look at the major markets because I can learn a lot about what happened the prior week. This top chart just looks at the major ETFs. In yellow are the major index ETFs, and notice how pretty much everything was red on the week except for gas, oil, commodities. Interestingly, the dollar was up with those, and gold was up a bit. Now, the only major indexes that were up on the week were the NASDAQ, the Qs, and the composites, and you could see they recovered enough on Friday to turn positive. Russell led to the downside, down 3%, the Dow 2.7, NYSE 2.2, and the Spiders 0.9. So a relatively weak week. WEAK for the markets. Now, this is a bull market by every sense of the definition. And you could see off the 52-week lows, which we are now lapping, we are up 44% on the Qs, 47 on the composite, 41.5 on the Spiders, 33 on the NYSE, 30% on the diamonds, and 35% on the Russell. This has been a market you wanted to be long on, but so often it made it difficult to be long. On the week that just passed, you could see the only positive sector was discretionary, followed by technology, and I think discretionary really got helped by the Tesla earnings. If we look at the Q Market Edge tool from my friend Sagar Nandi at superiorprofit.co, you could see that 73% of the sectors of the S&P 1500 finished down on Friday. Brighter for me. 66% of the industry groups and 66% of the stocks. So it was a negative day despite the outperformance by the Qs. Over here, it tells me that 60% of the stocks are below the midline of their Bollinger Bands. That's a bearish formation. And we can see we're starting to build up stocks in the lower half of their bands, and 7% are below the Bollinger Bands. Now, that's a higher number than the prior week, but it doesn't tell me that we are about to reverse because it can get as high as 30 to 40. Where a week ago, I was talking about how good the markets looked at over the last month. The last week was a tough week. 100% of the sectors were down, 86% of the industry groups, and 81% of the stocks are down. Now, I think the S&P 1500 is a great tool to look at because it includes the 500 large cap, the 400 mid caps, and the 600 small caps. This is also from Sagar, and this is his Q Market Breadth tool. This is using a composite of the NYSE and the NASDAQ. And what do I see here is we had what's called the Phoenix on Wednesday, which is a negative momentum signal, one that you often get either at the end of a bad sell-off or at the beginning. When you get it after the market sold off, it's typically get to that position where you expect a market rebound. This is at the beginning, and that could be a tough signal. We can see that the down volume certainly accelerated as the week went through, as well as the decliners. And in yellow, you could see stocks above the 50 took a pretty big hit. No accumulation or distribution signals over the last week. If we look at the NASDAQ versus the NYSE, we can see that that Phoenix occurred on the NASDAQ. Nothing else here of note except this 13-week new high, new low, which had been in an overbought area, certainly on the NYSE, has come down. And if you look at the broader indexes, you can see the diamonds, the 2000s, the NASDAQ 100s, here's the S&P 1500, and the 500. All of them were a week ago in a overbought area, and you could see they've all eased off of that. Now, here's my weekly timing model. This is not from Wealth Charts now. It's actually from my trading app. So I've incorporated a number of things here. The price bar, this is a weekly chart with the WMA, and notice all the major indexes that I track in my timing model are above it. And then you can see the bongo, which actually flipped to red on the spiders and flipped to red on the Russell and the diamonds. But for us to come out of the buy signal, you'd have to have both a red bongo on the weekly and price below the WMA. So if you look at the bottom bar, which is green for each, it says I'm still in a longer term buy. So this is my main direction model. The short term on the dailies, you can see that on the diamonds and on the Russell, we've already flipped, and we flipped for a couple of days this past week on the Q. So what does that tell me? It says it's okay still to be long. I should probably tighten stops, raise cash, which I've done, and probably not be very aggressive to the long side and start to think about the short side, but not necessarily pulling the trigger yet. This is in my new trading app, and you could see on Friday, the big loser was the diamonds, the big winner was the Qs. You could see that all the major indices finished in the bottom of the range for the session, and that volatility was up. When you look over here at NYSE, NASDAQ, various timeframes, new high, new lows, you could see we still have mostly new highs. When you look at one-day change, you can see discretionary, real estate, and tech were the leaders. And down here, solar, clean tech, lithium batteries, EVs, all I'm sure helped because of Tesla's outperformance. Now, this stuff is actually updated real time during the day on the trading app. Here's the same as Sagar, but we can also look at the sectors of the NYSE and see all of them down below 50%, whether it's sectors, industry groups, stock advances. You have to talk. And then the NASDAQ, 58% of the sectors are positive, 45% of the industries. Rising rates pressure the markets. You can see on the left, the 10-year straight up, on the right, the 30-year. And eventually that is going to impact on the markets. And perhaps that led to some of what we saw this week. Recession in our near future, I don't think one's coming very near. But whenever we revert from an inverted yield curve, the gray bars represent recessions. You always seem to get them, but they can be delayed. And I think it would be very convenient to see a recession come in sometime after the inauguration. I don't expect one anytime soon. If you look at the credit tightness, don't see any. And the diffusion index from the Philadelphia Fed still shows that we are in we still have decent economic activity. Breadth weakened. You could see stocks above the 200, stocks above the 400 came down in the week. And here is another view of that 3-month new high low applied to the entire market. Now, the other thing that concerned me was if you look at the AD line, so the AD lines are in yellow, the index or the ETFs are in blue. The NASDAQ composite went higher, but we have pretty clear divergence, new divergence, or additional divergence showing weakness in the NASDAQ on the AD line. Similar to the Q tool, Edge Rater is another tool for looking at the buckets, and you can see we're piling up below the midline, so more bearish, but it's not overdone yet to the downside. This is in my app that I've mentioned a couple times to be released soon, and this is looking at the NYSE, the NASDAQ, the Russell, and the S&P 1500. And I've actually been able to now look at the impact that different industry groups, or in this case, different indexes, to see where the ones that are the weakest. And you can certainly see that the NYSE is at 11%, the S&P at 12, 10 the Russell, and 8 the NASDAQ below the Bollinger Bands. We're starting to get good numbers there, but they can get bigger before the market reverses. We did see on the NASDAQ a Hindenburg Omen on Thursday. That just adds to the ammo that we have risk in this market. Notice that on the NYSE, there's almost no new lows, and that would mitigate some of that risk. If we look at the Edge Rater warehouse tool, and we recognize I take all the stocks, $2 and 250,000 shares, I apply them to an ERG, which is EPS rank plus relative strength rank plus group rank, and then plotting performance versus ERG. I throw out the tail because there's very few stocks. I throw out the heck because there's few stocks. What you have is pretty much a straight line of negativity, showing that the market did poorly this week. Now, interestingly, yes, good earnings per share stocks did better than poor earnings per share, but everything did bad. Same thing with relative strength. Having relative strength was good, but it was still a negative performance. What I thought was interesting was that the groups that were distributing the prior week, that would have been the week between the 11th and the 18th, actually had the best performance on the week. Busy week for news and earnings. You could see nothing on Monday. Case-Shiller, consumer confidence, job openings on Tuesday, ADP employment, GDP on Wednesday. The PCE complex, which we know is closely watched by the Fed with some jobless claims and employment cost, PMI, and then Thursday, on Thursday rather than on Friday, the monthly unemployment reports. From an earnings perspective, this is a whopper week. AMD, Alphabet, CMG, Visa on Tuesday, Lilly, Meta, Microsoft on Thursday, Amazon, Apple, Intel, Uber on, AMD, Alphabet, Chipotle, and Visa on Tuesday. Wednesday's Lilly, Meta, Microsoft. Thursday, Uber, Amazon, Apple, Intel. And Friday, we're starting to get some energy names. So this is a busy week for earnings. And as I say in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So selling pressure this week, not surprising after 6 weeks of gains. I think the interest rates are causing an issue. And part of why, I think there's also some concerns about the election. Interestingly, probably because of or benefiting from Tesla, the mega cap MGKs were up, as was semiconductors. Tesla, again, supporting the NASDAQ and the mega caps. As I said, my weekly model is still long, but there's definitely cracks. The election is less than 2 weeks away. I cut some positions, but I'm still net long. Stops are in place, and I've raised some cash. Onto the charts. So let's kill that. And let's go into the indexes, and let's just go look at the dailies. If we look at the spider dailies, you could see on Friday we were down just a tad. And as we mentioned before on the weekly charts, we were down almost 1% on the S&P 500. Now, if you go back to time, this is a run that's been going for quite some time. And we've seen some pretty significant pullbacks before we resume the rally. This could be just another one of those soft corrections. It could turn out to be more. Looking at the Qs, unlike the spiders, we've not made a recent new high. That's a shooting star, which is a bearish candle, even though it was up 0.61 on Friday. It's showing signs that it might be developing divergence, so I think there is some risk here in the Qs. The diamonds, similar to the spiders, made a recent new high. Modest sell-off here. Is this just another of many? Do we bounce off the 50 and go higher? I think that's very possible, but I think that's something I'm going to watch. Obviously, we'll be looking at what happens with Israel, Iran, and the rest of the market. And then on the Russell, you could see it did pull back to the 50, and this has been underperforming compared to the others. And you could see it was down 0.38. If you put up a weekly view of the Russell, you can see that it has been rallying of late. It is nowhere close to its prior highs. You have to go back, I think, to 2021 to get to the all-time highs. So the Russell is different, but it has been coming off the highs, and let's see, it was down on the week. It was down 3% after a couple of stronger weeks. All right, let's take a look at commodities. Actually, staying on the dailies, let me just go back to take a look very quickly at volatility. Look at the VIX on the week, and you got a green candle up 12%. And you see here the dollar. So it's not just the rates that have gone up, it's also the US dollar. If we jump into commodities, and let me reconnect my Tasty Trade. You all know my password, lots of dashes. Unless it doesn't like me here. All right, I guess it's not going to do that. You can see here gold off of all-time highs, but very close, up 0.21. Silver was down 0.2 on Friday. Oil bouncing around here was up 1.6. Now, Israel did bomb Iran, and it seems to be a measured blow. So that might mean some of the risk will come out of gold and silver, so they could come down as well as oil. But let's wait and see what the market does. We already know the 10-year is trending higher. So we're going to go ahead now and look at the hourly sectors and see if there's anything that stands out as strength compared to others. And when I looked at it, what impressed me the most was look at this strong recovery in discretionary, again, probably led by Tesla, also technology, communications. Look at the weakness in material, look at staples and real estate doing poorly as well. Going into the scanners and taking a look at the heat map. Remember, this heat map includes after hours trading as well. But you could see in most of the big cap tech names were green on Friday. NVIDIA actually did better in the day that it shows in that box. It was up 0.8. NVIDIA has broken out of this trend line here and seems to be doing well and leading the market. It'd be interesting to see how its earnings were. Tesla, you could see what happened on earnings. It had a big gap up and traded higher. Apple, earnings this week, broke above the trend line. That looks interesting to me, but earnings are there, so I'd be careful opening new positions. Meta, take a look at Meta. Meta is pulling back. This has been a leader. Earnings are coming. Microsoft is bouncing around here. Technically, it looks like it took out this trend line and failed to stay above it, but a break above that will be interesting. Amazon, we're talking about the same thing as the others. Got a trend line going on here, and will we break above it or break below it? If we look at Google, it'll look a lot like Microsoft. And then Netflix has also been doing well, just off its all-time highs. Now, if I go into the wealth scanner and I look at the various ETFs, the first thing I'm going to show you, there's only 3 of them that are above 800 or above. One of them at 700 short the bonds. This is clear-cut weakening and something to be concerned about. Now, I don't ignore the fact that I got flames with the NASDAQ composite and the Qs showing some outsized strength there. Now, the interesting thing is when I look at the CAT scanner, I look at my combo leaders list, you're going to see quite a few stocks were 4+, and I think all of these pretty much had earnings. Aon, a big gap up on earnings, 9.68% beat. Look at the high low, it's at 100. It's probably too extended for me to chase. Boyd Gaming, these are all Thursday night earnings, 10% beat, big gap up, extended. Bank One, I feel like a broken record. It is showing you that if you make 20% beat, if you have a good earnings report, you're going to get a boost. Now, this one is not too extended to buy. Volume breakout momentum, great relative strength. Closed at the bottom of the bar, so I wouldn't, I'd like to see it take out perhaps the open before I got too excited. LHX, a defensive play. Again, broken record, big earnings, not a big win, but 2.5% win. Not yet extended. Relative strength in OBV. All these look like they sold off later in the session. Even Newell Brands, Rubbermaid, not the kind of stock that I usually trade. Looking through this list, you can see there are a number of stocks that had earnings. I'm going to go pull up my buy watch list and try and narrow it down for the sake of time, as on vacation here still. And these are some of the stocks that I looked at that looked interesting to me this weekend. and actually just go to momentum up. Aon we already looked at. This is an insurance broker, I believe, and it's something that I'll be looking at other insurance stocks. Deckers, outdoors, same story, 28% beat. It's pretty massive. Held most of its gap area. Big volume, breakout momentum out of a squeeze, not extended, relative strength at OBV. I think that one looks really good. ResMed is a medical device company, a CPAP machine company, 7.84% beat. Sometimes this is tied to what people think will happen to GLPs. Will people still be fat and have sleep apnea? Tapestry, another big move. Now, this one was not just an earnings move. This was a move because the deal with Capri fell through. That tells you what the markets felt about Capri. All these stocks look interesting. That's why they're on my buy watch list. Texas Roadhouse, I don't really love their food. In fact, there's no way I'd go eat there. But look at the volume that came in the last two sessions coming out of a squeeze, great relative strength in OBV, and not extended. So there are a lot of things that look good. Cincinnati Financial, uptrend pullback breakout. If you like Aon, maybe you'll like Cincinnati Financial, similar industry, great relative strength in OBV, not extended. Earnings are out, and they had a miss, and they still went higher. Isn't that interesting? Anything else that I want to show you? In the energy side, Vista Energy had a breakout on earnings. I think energy may be challenged a little bit if Israel and Iran simmer down, but this one is probably the best looking of the energy producers that I saw. EQT was another one. I think this one has natural gas, but it's overall still in a downtrend, so not that exciting to me. And I think that's enough. So I'll leave you with one I talked about last week, and one that I think is probably the hot one to get taken over in the biotech space, and that's VKTX. And it's one that I currently hold, just to be fair, and it's pulled back after a big run. They have an oral GLP-1 weight loss drug that looks interesting, and I think this is one that if I had to pick the most likely to be acquired, I have no inside information. I don't do work with the company, but I know how hungry Big Pharma is for exciting big growth areas. Have an awesome week in the market. I'll be intermittent on stocks and docs until I get back home.